So we are looking at the concept and need for assurance. Concept and need for assurance. So let's go to our first. Let's look at the meaning of audit. Now, what do we mean by audit? What do we mean by audit? Some people define audit as the independent examination of financial statement in order to ascertain whether the financial statement show true or fair view. And what do we mean by true and fair view? We are saying that is the financial statement, does it comply with the rules and regulations or with applicable standard? And that's what we mean by when something have true and fair view. Are we together now? Are we together? So let's define audits. So according to ICANN, they define audit as the official examination of account of an entity. Official examination of account. Who examines the account? Who is the person going to examine the account? The external auditor that will examine the account. Am I communicating? So we are going to look at the concept of the audit, but just let us take that into consideration. And what are you looking for in the account? Why are they examining the account or the financial statement? The reason why they are examining the financial statement is to ascertain whether the financial statement whether the account is prepared in accordance with laws, regulation, and applicable standard. So the main objective, what is the main objective of audit? The main objective of audit is to enable the auditors to form an opinion. Because now when you look at assurance and when you look at audit, that's the final stage of audit. Writing a report to enable the auditors to what? To form an opinion about the audit. So we have looked at the meaning and the objective of audit. Am I communicating now? Now I don't want to explain the concept of audit yet. We are still going to, so that we won't be taking much of our time. So let's go to concept of accountability, stewardship, and agency. Accountability. So let's go to the concept of what? Accountability, stewardship, and what? Agency. So we are going to use this to explain what we mean by audit. Now, when we talk about stewardship is what you are managing is not your own. You are being delegated authority to carry out that activities or that business for someone. Are we together now? For someone. That means we can say that the directors and the management, that is director or management of the company, is a steward. Am I communicating now? Is a steward. But stewardship will come into existence when the person that owns the business and the person that owns the business are two separate what? Individuals. That means if the person that owns the business and the person that is managing the business is one individual, that means the issue of audit will not even come in place. Am I communicating? Let's say those that are owning the owners of the business are the one managing the business. Will you need the audit? You will not need audit. So stewardship is the steward are the directors. Am I communicating? The steward are the directors of the company, and the steward, am I communicating now? That means the director of a company has a stewardship role to play. And one of the roles to play that they will play is to what? Is to manage the assets of the company and manage the what? And operate what? The company in line with what? With the objective of establishing that business, right? Now, if you are giving a stewardship role or you give someone to manage something on your behalf, that means the person has a function of being accountable to whoever owns the business. That is why we have stewardship and accountability. So they are meant to report to who? To those that owns the business. And when we talk about agency, I've explained agency. When you get agency theory or agency means that it is the management or the directors that are the agents of the company. That means the principal are the owner. And that's the reason why audit is required. Am I communicating now? Because audit help to add credibility to whatever the steward is providing. That means the financial information that the steward will provide to who? To the owner. Am I communicating now? Am I communicating? Are we together? No, you can now know with this now. You now know the reason why audit is important. Why shareholders require that a financial statement being prepared by the directors should be audited, so that they will not rely on wrong information. So what an auditor is doing when auditing an account and reporting it to shareholder is that he is providing a credibility to whatever they are provided. That this information does not show any material misstatement. Am I communicating now? So we have explained the concept of accountability, stewardship, and agency. Are we together? So let's explain this now. Now, I have told us that the director, am I communicating? The directors are the owner. That means the financial statement will be prepared by the director. Directors are the steward. So they will prepare the financial statements showing the performance and how the assets are built and managed and the liability that they have incurred. So it will be showing the financial to who? To the shareholders. Now, can you see now? That means the shareholders cannot just rely on this financial statement because it can be It can be manipulated. The profits can be overstated. The assets can be overstated. So they may not want to rely on it because relying on it means that they can, if it is overstated or understated, they can make the wrong decision. Because the essence of accounting in the first place, or the financial statement or financial information, which is the financial statement, is to provide them with information that they will use to decide whatever they want to make decision on. Am I communicating now? That means they want to, I need an independent person to come and examine what you are presenting to me. So it is when the financial statement is audited that you now add credibility to it. That means they cannot rely on it. They cannot bank on it because it has been reviewed or examined by someone that does not involve or that is not involved in the preparation of the financial statement. Because the shareholders are not there when it is being prepared. They may not even have an idea of the kind of assets that they have. Am I communicating now? So this is the concept of the audit as the first place. So let's continue. Please hold on. Now, it means that the person adding credibility to it, which is the auditor, right? Which will be the one that will examine the financial statement, must have a level of independence. Because if it does not have a level of independence, it means it cannot add credibility to it. Just imagine that the people that are preparing the financial statement are those that are examining the financial statement. You are the judge in your own story. You are the judge in your own case. What happened? We will just be deceiving ourselves. So there must be high level of independence. That means the auditor must be what? Must be independent from who? From the directors. That means it must not be under the what? Under the control of the director. Because if it is under the control of the director will be, it is what the director says that they will, that the auditor will follow. Am I communicating? So we have talked about the independence of an auditor. So let's go to the concept of true and fair view, or we call it faithful and fair presentation. So we have talked about independence of an auditor. So the auditor should be independent and should not be under the control of the auditor, especially the external auditor. They should not be what? Accountable to the directors. Am I communicating now? So let's go to the concept of true and fair view, because you'll be hearing fair and fair view, or you call it fair presentation. Fair presentation. Now, when you hear the word true, what's the meaning of true? True implies that it's free from error. True. When you hear true and fair, that true means free from what? From error. Why fair means that there are no what? Undue what? Bias in the financial statement. True means that it is what? Free from what? From error. That means the financial statement is free from error or from material error. Why fair means that there is no undue what? Bias when preparing or in the financial statement. Am I communicating now? So when you say true and fair view, that means we are saying that the financial statement is prepared in line with what? With rules and regulation and with applicable what? Standard. Am I communicating now? Are we together now? That is when an auditor gives that opinion. When an auditor gives an opinion that financial statement is what? Show a true and fair view. It means, look at it. It means that there is no material misstatement. Because sometimes financial statements may have error, but it is not all errors that are what? Material. So what the auditor is concerned about is errors that are what? That are material. So immaterial error, they may still give what? Even though if error is still included in the financial statement, as far as that error is not material, the financial statement can still show true and fair view. Am I communicating now? So what do you mean by material? When you hear the word material or materiality, materiality means that an information is said to be material. An information is said to be material if omitted or misstated, the information will affect the decision of users of that information. So that information is said to be material. Look at it now. That means if that information is misstated, you were supposed to be black, or you're supposed to be right, you're supposed to write 5,000 in the financial statement. You now write 4,000. That is misstated. Omitted means completely what? Not reported in the financial statement. If it will affect the decision that you make as a user, that information is said to be what? Material. Am I convincing now? So, see, look at it now. That means an information is immaterial. If it is omitted, if it is misstated, it cannot change your decision or it cannot influence your decision. That means it is immaterial. Am I communicating? So, that is what we mean by materiality. So, I've explained what materiality concept is now. Are we together? Are we together? So an information is material if, look at it, an information is material if it could influence economic decision of the users. Should the information be omitted or misstated? It's still the same thing I'm saying. So if the information is to be misstated or omitted and it will influence or affect your decision making or your decision, or it means that information is said to be material. How we use together? Are we together? And when we say materiality, see, what is material in one company may not be material in another company. So what is material in Dotun Limited company now? What is material in Dotun Limited company may not be material in Dangote company. Am I communicating now? So, but materiality is not only about value, it's about the nature of the transaction. Are you? Some transaction may have a related party transaction that is meant for you to disclose that information. Are you? It will not affect your profit, but you should provide the information. You should not hoard that information. So, it's materiality. It depends on what it can be based on value or based on the nature of or the risk that is involved in that transaction. Am I communicating now? Let's go to the statutory requirement for audit. The statutory requirement for audit. The statutory requirement for audit. Now, what do you mean by statutory requirements for audit? Now, what do you mean by statutory requirements for audit? You know what it is in some company in Nigeria now, it is required that you audit, especially companies that are traded on Nigeria Stock Exchange market. It is mandatory that you audit your financial statements and you have an annual audited financial statement. In fact, interim financial statement, maybe every quarter, you are meant to even present your interim financial statement. So it is mandatory in Nigeria that there should be an annual external audit that should be carried out on the financial statement. That means you should carry out an audit on your financial statement annually, both private and public company. What is private company? Private company. So what is public company? No. So private company is a company that have restriction. You know what I'm saying? They can't trade their shares. That means their shares cannot be traded on Nigeria Stock Exchange market. That's private company. Right? What public company are company where their shares can be traded on Nigeria Stock Exchange market now. It is not all limited liability company that you have their shares on Nigeria Stock Exchange market. It's only public limited liability company. That's why you see most of these big companies, you have PSC. They are limited, but PSC is a public limited liability companies now. But it is not all companies that the law require for them to what? To provide an audited financial statement. That means it is not all companies that should carry out an annual external audit on their account or on their financial statement. It's not all companies. Some companies are exempted from it, which we are going to look at later part of the material. For example, partnership, trade, sole traders, what's it called? Clubs and society organization are not, they are exempted from, yes, they are exempted from providing there are still some private companies that are exempted from carrying out, if they choose, they may not carry out an annual external audit on their account, or on their financial statement. We are still going to look at the later part of this material. So let's go to assurance. You know, we have talked about audits. We have talked about audit. What do you mean by assurance? Like, let's go to assurance now. The meaning of assurance. Meaning of what? Of assurance. So let's go to definition of assurance. As I say, assurance is not what Davido sang. It's not Shoma. Assurance means what? Confidence. No, even the song that Davido sang, assurance, it means I have confidence in you, I have confidence in you. That's assurance means what? Confidence. Yeah, you know, I was explaining the concept of audit the other time. That it is the director that will prepare the financial statement. What they will present it to who? To the shareholders. But the shareholders will not just want to rely on that information because they don't have confidence in the information. If they have confidence in the information, they may not require an auditor. Now, because they require a confidence, credibility, are you getting on the information? That is why they engage auditor. Now, you will now be looking at what is meaning of assurance, what is the meaning of audit. Assurance is more wider than audit. Am I communicating now? Assurance is more wider than audit. That means audit is part of what? Assurance. Are you there? Audit is part of assurance. Am I communicating now? Because in assurance, one party is engaged. One party engage another party. Am I communicating now? In assurance engagement, a firm is engaged by one party. That means a company will engage one party to give an opinion on the piece of information that is being prepared by another party. You can see now. Are you getting what I'm saying now? In this now, we can see that there is audit in assurance. Because it is not all examination of information that is audit. It is when you are examining financial statement or account. That's what we call audit. Am I communicating? Are we together now? Now, in assurance, it has to do, even review is different from audit. I can review an information from my client, maybe the inventory system, help them to review it or to examine their inventory system or their asset register. It is not. Is it audit? It's not audit. Most of this thing we call audit is not audit. Am I communicating now? That is review. Am I communicating now? Now in assurance, that's why I say audit is part of what? Of assurance. So we are still going to go to level of assurance. That's why you see that audit require an high level of assurance, while some other assurance services or engagement involve low level of assurance. But let's go to do that now. So assurance, in assurance engagement, an assurance firm, who is an assurance firm? That means an audit firm or an auditor is appointed by one party. Who appoints him? Who appoints that auditor? It means the shareholder, that the one that appoints the assurance provider. Am I communicating now? To examine the piece of information prepared by what? By another person. That means the person examining the information, am I communicating now? Is not the same person that prepares the information. Are we together? And the person that engaged the person to examine that information is not the same person that prepared the information. So in assurance service, there is what we call a three-party relationship. The responsible party, the practitioner, which is the assurance provider, and the intended user. The intended user is the person that wants to use the piece of information that was prepared. Are we together now? Are we together? Are we together? So let's go to level of assurance. Level of assurance. Level of what? Of assurance. So we have reasonable assurance and limited assurance. So there's two types of assurance: reasonable assurance and what? Limited assurance. So that's the two types of assurance, two levels of assurance that we have. Now, when we say reasonable assurance, we are saying that assurance that is what? It is high level of assurance, and you give that kind of assurance when you are what? When you are what? Carrying out an audit. Are you getting what I'm saying? What I say assurance is, I say confidence. So there is high level of confidence. That means if you are sure that there is material misstatement in this thing, don't say that there is what? There is true and fair view. That's why they say it requires high level of assurance. For you to form high level of assurance, it normally take time and normally require a lot of what? Work. That's why you see when financial statement is prepared and it is given to an auditor to audit, they may give the auditor like 2 months. But if I'm to audit or if I'm to examine the asset register of the company, it may not be more than a week or 2 weeks because high level of assurance is not needed. So that means every information that I needed, I will require for it, and I will look at it what? Carefully, so that any assurance that I'm providing, because in reasonable assurance, I say reasonable assurance require what? An high level of assurance that is provided by what? By who? By the practitioner. In assurance, please, in assurance, you don't call the practitioner auditor, because practitioner does not only provide, or assurance provider does not only provide audit service or engagement. There are some audit related services that an assurance provider provide. Am I communicating now? There's something called non-related audit services. Who can tell me non-audit related services? We have corporate social responsibility reports. They are non-audit related services. You know, in annual report does not only contain financial statements. You agree with me? In annual report, you will have employee policy. You will have corporate social responsibility reporting. You have sustainability reporting. You have employment policy reports that they will provide. Annual report contains so many things. It's not only financial statement. So the auditor may also be, the assurance provider can also be engaged to what? To look at those reports that is being included in the annual report. Am I communicating now? So it's not only audit. Am I communicating now? So now when you providing an reasonable assurance, I told us that is high level of assurance, high level of confidence that this information that you are providing or that you have reviewed does not show material misstatement or show material misstatement. And the opinion of the assurance must be of the assurer, or the assurance provider must be in positive what? Format. that, look at it, an example. In our opinion, that means the assurance provider is the one providing this now. That's how high level of assurance look like. You say, in our opinion, that the account have show a true and fair view. Are we together? Show a true and fair view. That is what? That is a positive form. Am I communicating now? A positive form. Are we together now? So let's go to limited assurance. So it gives a low or moderate what? Level of assurance. That means it does not require an high form of assurance. And this kind of level of assurance is given when you are carrying out review. You know, I told you review is different from audit. Review is meaning that you are reviewing an information, an item. Is not audit, is not examination of financial statement or account. And I say I want to review that I'm being engaged to review the asset register or to verify the asset that the organization has, or to look at the inventory system or the inventory record in an organization. What am I doing? I'm reviewing. So that review, it requires a low or moderate level of assurance, and it is expressed in negative what? Form. Look at it now. Look at example of moderate or low level of assurance. That nothing has come to our attention that causes us to believe that this information does not give a true or fair view. That's what review. Are you know? Is given in negative form. That we have looked at it, but there's nothing that has come to our attention to show that this information is not what? Correct. No, it's different from the other one. Can you see now? Even though it's correct, we are giving it in negative what? Form. Are we together? So please, let me just say this. I don't need to expatiate it. We know the difference between external audit and internal audit. External audit is an audit of financial statement that is being done by what? By an independent person, which is not an employee of the organization. While internal audit is an audit that is being done by an employee of the organization. Am I communicating now? And who does internal auditor reports to? Who does internal auditor reports to? Who? Internal auditor reports to the management. Yeah. While external auditor reports to the shareholder. So please, you can look at. So we don't need to dwell much on that now. So I've explained what review is. You know, I don't need to. So in review, I told us review. One of the difference between review and audit is that one of the difference between review and audit is that audit consume more time. Review does not contain more. Look at it now. See, look at this now. You are trying to examine or you are trying to review the financial statement, the item in the financial statement. Review whether the PP is correct. You are being engaged to look at whether the PP, to look in-depth, to look in-depth analysis or in-depth, let me say in-depth examination of the PP in the financial statement. It's just an item in the financial statement that you are examining. Can you see now? Compared to someone that is auditing the whole financial statement. Can you see now? Audit is time consuming, while review is not time consuming. Look at it now. They say a review is a voluntary investigation. Can you see? What are you doing in review? You are investigating. That's why I say in-depth examination. That's what we are looking at. Review. Are we together now? So another difference between review and audit is that audit is more costly because you spend more of time on it. That means the assurance provider will want to charge more for an audit than what review that you are just reviewing, because the scope of work in review is not that what is not that large. So the cost that a client will incur on review will be more lesser than that of audit. So please, so let's go to element of assurance. Element of assurance. Element of assurance. That's all. Let's move into that. Element of assurance engagement. So element of assurance engagement. So in one of the elements is what we call a three-party relationship. We have a what? A three-party relationship. We have subject matter. Subject matter. Three, we have suitable criteria. 4, we have evidence. And 5, we have assurance reports. Assurance reports. So let's look at each of these elements one after the other. You know, I was explaining to us that when it comes to assurance, that we have what we call three-party relationship. You know, I stated it when I started the class, that we have three-party relationship. Who are the three parties? We have the practitioner, the responsible party, and the intended users. So who is the practitioner? That means the individual or the individual that is being engaged to carry out assurance services. Am I communicating now? Yes, to carry out assurance services is what we call the practitioner. Example, we are auditor or the assurance provider. That's what we call practitioner. Am I communicating now? The individual or the firm that is employed to provide what? Professional services for or to provide an assurance on a particular information is called the practitioner. So we have three-party relationship. We have relationship between who? Relationship between three individuals. The practitioner, responsible party, and the intended user. So I've explained that the practitioner is the individual or the firm that will provide a professional services on assurance to a particular client. So the responsible party now is the person responsible in preparing the information that will be audited by the practitioner. Am I communicating now? Who is the responsible party for the preparation of financial statement in an organization? Who? The directors, the management, they are the one in charge of preparing the financial statements in an organization. Am I communicating now? So the intended user now is the person or class of person that appoint the practitioner to review or to examine the information prepared by the responsible party. So in an organization now, when we are looking at audit now, who is the intended user? The intended user is what? The shareholder. Am I correct? And that is what we have in assurance engagement. In assurance engagement, that means in assurance engagement, the responsible party cannot be the intended users. And what are you providing? What are you providing assurance for? If the person that prepared the information is the person that engaged the practitioner to come and examine the information, am I communicating now? Now, the information, when you look at your material, the information that the practitioner is examining, or that the practitioner is examining, or the information that will be prepared by the responsible party can also be called the subject matter. So when you hear subject matter, it means the information or financial statement or financial information that will be prepared by who? By the responsible party. It can also be called subject matter. So let's go to the subject matter. What do I call subject matter?
The responsible party. The director.
Subject matter. You are not here. No pastor is sleeping. That means the subject matter is that piece of information that is being prepared by the what? By the responsible party. So the subject matter can be who? Can be the financial statement. The subject matter can be PPE register. The subject matter may be inventory record. Am I communicating now? So the subject matter is that data or the financial information that is being prepared by what? By the responsible party. That's what we mean by what? But because if you are engaging a practitioner and there is no subject matter for him to carry out the assurance services or to render the assurance services that you are being engaged for, what is he doing? That means he's not providing assurance to anything. He's just speaking. So there must be a subject matter. And that subject matter is refers to the data or the information that is being prepared by the responsible party. Am I communicating? That's what we call subject matter. So let's go to suitable what? Criteria. What do you mean by suitable criteria? Am I communicating now? That means suitable criteria, it is the basis. Am I communicating now? That is used in the preparation of the what? Of the subject matter. Look at it now. If you want to prepare financial statement, what are you going to rely on in preparing the financial statement? That means the accounting standard, right? Accounting standard. And the accounting standard, that's what you are going to use, right? Now, for the assurance now, look at it now. For the practitioner now, to know whether it is prepared in accordance with the applicable standard, what is he going to rely on? It will rely on the provision of the standard, because that is the information, or that is the law, or that is the basis or the accounting framework that I can use as a basis upon which to know whether the subject matter is prepared right or wrong. Am I communicating now? That means the subject matter, the suitable criteria, this can be, look at it now. Look at this now. You cannot be, you want to look at the PP register now. You want to examine, or you have been engaged to examine the PP schedule. Am I communicating? Property plan and instrument schedule. Now that's what you are engaged to do now. Can you now be using IFRS 9 financial instruments as a basis or examine whether the PP schedule is prepared right or not? Are you going to use IFRS 9? Are you going to use IFRS 9? Are you going to use investment property? No. I-40. What are you going to use as a basis to know whether it is prepared rightly or not? What? I-16. Because that is the law, or that is the standard upon which the subject matter is what? Is prepared. Am I communicating now? So that the suitable criteria can now help the practitioner to form and to reach an opinion whether it complies with with relevant standard or relevant law or not. Are we together? So please, now let's go to evidence. So if the practitioner is looking at the suitable criteria, what is he trying to do? Upon which the subject matter is prepared. What is it trying to do? It's trying to what? To get evidence. I mean, to gather evidence. So evidence is required by the practitioner, because without evidence, the assurance report cannot be prepared. Am I communicating now? And this evidence must be what? Must be sufficient and appropriate. Sufficient means it must be what? Sufficient means it must be enough. There must be enough information for you, for a practitioner to what? To draw or to form an opinion. You can't say there is material misstatement in what you have carried out on without an evidence. What is the evidence of material misstatement? That means you must gather enough evidence that will support, and that evidence you supply must be what? Appropriate. When you say appropriate, it means it must be relevant. You can't be auditing PPE now and be using IS-40 as a basis that, or fair value method, fair value model in IS-40 as a basis for you gathering information that the information does not show a true or fair view, or there is material misstatement. Is it relevant to it? What are you going to use? PPE. So that means your information must be what? Sufficient and appropriate. And when you say sufficient enough, when you say appropriate, relevant or reliable. When you reliable, it means something that you can rely upon. Am I communicating? So let's go to the last. Let's go to the last element now, which is assurance what? Report. Am I communicating? Now, the practitioner can go to the intended user and say, there is material misstatement, or the information you have given me, there is material, then it is prepared, it shows a true and fair view. Will you just say that? That means he has to write a report. And that report is normally what? A written report that will write, that he will communicate, or that will contain his what? His opinion about the subject matter in which he has what? Carried out an examination upon. And who is he going to issue that report to? He's going to issue that report to the person that engaging. And the person that engaging in the three-party relationship is who? The intended what? User. So let's look at differences now. Differences between assurance, attestation, between audits, assurance, and what? And attest. Now let's look at it now. Now we have explained assurances. That assurance involve the assurance involve where a practitioner is engaged by another parties to give an opinion or to examine a piece of information that is being prepared by who? By another party. Am I communicating? Now, don't forget, I told us that assurance is wider, it's more broader than what? Than audit, because audit also is a form of what? Of assurance. So we have explained that now. So what do you mean by audit? What do you mean by audit? We've defined what audit is. That audit is the official or independent examination of account. Are you getting that? In order to show whether the account complies with what? With rules and regulation and relevant standard. Am I communicating? And audit is required when there's what? When audit is required when there's what? When there's the person, the owner is different from the what? From the, no, it's not business now. That means the owner, the owner are different from those that manage the business. And that's what we call agency theory. That means the principal and the agent. That means the principal is the shareholders, while the agents are the what? Are the directors. So because the directors, it is required for the directors to be accountable or to provide an information on how they have been able to manage the business on behalf of the what do you call, on behalf of the shareholders. It is now required for the shareholders to now engage someone, which is the auditor, to add credibility to the piece of information that the agents have prepared. Am I communicating now? So let's now go to attestation. So we have explained what audit is, what assurance is. Normally I was supposed to just go to attestation because we have explained audit and assurance. Attestation is audit related engagement. What do I call it? It is not audit, but it is related to what? To audit. What did I say? It is not audit, but it is related to what? To audit. It is audit related engagement undertaken by who? By an accountant or group of an accountant or firm of an accountant to perform a specific assignment. So that means attestation is not an audit. It's audit related engagement. It's related to engagement. So what are the examples of attestation? Am I communicating? We have review, agree upon procedure, and compilation. What do I call it? Review, agree upon position, agree upon procedure, and compilation are examples of audit-related engagement. You know, review is not audit. You are reviewing a data or you are reviewing an information is different from auditing the financial statement. So you can see that you can use the same procedure that you're using to audit the financial statement for your review, but it is not audit. It is similar to what? To audit. Am I communicating? Review is maybe a data or information you are trying to what? To review it. Am I? Agree upon procedure is when, look at it now. Agree upon procedure. Look, I'm just explaining. I'm still going to explain it in detail later. Agree upon procedure. It is when a client provide the procedure that a practitioner will use to carry out an engagement. Look at it now. You say I should come and start. You say I should come and audit. Look at this. Look at this. You say I should come and carry out an examination of the PP schedule. You now give me a procedure on how I will carry out that engagement. That is agree upon procedure. That means that the procedure that I will use for has been prescribed by who? By the client. So the client has prescribed the procedure that I will use to carry out that engagement. So if I do not agree with it, that means I won't take up the engagement. So if I agree with it, that's the procedure I will use. I will not go outside the scope of the procedure. That is agree upon procedure. Compilation is when you are helping a client to prepare an information. You know, it is not review now. It is not that you are examining any information. You are helping a client what? To prepare an information. It can be financial statement. You can help a client to prepare their financial statement. You know, there are some companies they don't have the capacity to engage a chartered accountant to be paying a chartered accountant on a monthly basis to prepare their financial statement. They may engage someone maybe when the accounting period comes now. They will just provide the little account that they are keeping to a firm to prepare their financial statement for them. That is what compilation. Sometimes companies also engage accountants to prepare tax return for them that they will file with the Nigeria Revenue Service. It's called Nigeria Revenue Service now, not Federal Land Revenue Service. It's called Nigeria Revenue Service. So can you see the difference between audit, assurance, and attestation? So let me stop now. You have to give the auditor. Am I communicating now? So the right of an auditor, he has access to what? He has the right to access all accounting books and record at all times. 2, he has the right to what? To information and explanation. If there's any information you have given the auditor and the auditor does not understand it, he can demand someone to come and what? Explain. So he can say he don't know. So who is in charge of preparing this accounting record? He can ask, you are the one, please. I've gotten the record because I don't understand how you come about this. Please explain. So he has the right to what? To all information and explanation necessary. Are we together? He also has the right to receive notice of meeting of shareholders. That means whenever shareholders they are to meet, he has the right to also receive a notice that we are to have a meeting, that they are to that whenever the shareholders want to meet, he has the right. They will send notice of meeting to the shareholders. He also has the right to receive a copy of the notice of meeting. Am I communicating? Because he will attend. 4, we have mentioned right to access to all accounting information and record at all times. 2 is right to all information and explanation necessary for proper conduct of the audit. He also has the right to receive notice of meeting of shareholders and also to attend the meeting. That means when there is annual general meeting, that means the notice of meeting will also be sent. As it is sent to the shareholder, it will also be sent to the auditor. 4, he has the right to speak at the meeting, at the shareholders meeting. That means at the annual general meeting, the auditor can stand up and speak. Nobody can shut him up. He has the right to speak at the shareholders meeting on matters affecting audit or affecting him as an auditor. Now, lastly, that is 4. 5. He also has a right to receive a copy of resolution of the meeting. What would you call resolution of the meeting? We call it minute of meeting. That means after whenever the shareholders meet, they will only have a resolution what they have agreed upon, which will be documented by the secretary of the company. So he also has the right to receive a copy of the resolution that is made at the meeting. Are we together? Are we together? What's the time? So let us go to this. So I know I've explained rights and duties of auditor, but in videos I paused the video, so I didn't remember to resume the video again, to play the video again. So please, I'll start from because I've exempted this to outline for me. So let's go to our recap. So audit, let's go to small companies audit exemption. Small audit. I was saying that it is rare for all companies to carry out an annual audit on their financial statement. But it is not all companies that is required to carry out an annual audit on their financial statement. There are some companies that are being exempted. Now, CAMA, that means Company Analyzed Matter, actually prescribe which company can be exempted from what? From carrying out an annual audit. And it refers to that companies as what? Small companies. Now, the section, that means section 402 of CAMA states that small companies are exempted from what? From carrying out an audit. They are exempted from carrying out an audit. There is an audit exemption for them, but however, they must meet a certain what? Provision or condition for them to be classified as a small companies. It is not all companies that are small companies. So when you fall under or when you meet that condition, you can be referred to as small companies. So let's now go. What qualifies to be a small company now? A small company, it must be a private what? Company. A private company having a share capital. And I've told us that a private company is a company that is restricted from what? From trading their shares on the Nigeria Stock Exchange market. So that means public companies is not a small company. Am I communicating? That's one. Two, their turnover must not be more than the amount of the turnover of the company. That means the revenue of the company for that year. That means must not be more than what? 120 million. That means if their revenue now is less than 120 million, but by next year is more than next 120 million, what are they going to do? That means they are going to do they are not exempted from audit for that year. Whenever year they are not exempted from what? From audit. What are they doing? Any year that they make more than 120 million, that means they are not classified as a small company again. So two is that their net asset value. Net asset is when you remove their asset from their liability. If their net asset is must not be more than what? 60 million. So if their net asset, if any company net asset that is a private company, even though it's a private company, is more than what? 60 million, is not exempted, there's no audit exemption for that company. Am I communicating now? That means that company is mandated to carry out an annual audit on their account. That means, but if it is less than what? 60 million, that means they are still under what? That means all the provision of this condition must be satisfied for a company to be referred to as. Number four condition is that none of its members, that means the directors of the company, none of the members or the shareholders, none of its members is an alien. Alien means a foreigner, maybe a Ghanaian or someone, a British. Are you getting what I'm saying? Or an American. It must not be an alien. So what they have a member that is an alien, a shareholder or the director that is an alien, they must also the shareholder, let's say shareholder. If they have a shareholder that is an alien, that means they are not audit exemption for them. So none of its members is a government or government corporation or agency. That means any government corporation must not be a shareholder in that company. So when there is a government corporation or agency that is a shareholder, or any government, maybe state government or federal government that is a shareholder in that company, is not referred to as a what? As a small company. So it cannot be classified as a small company. So two is that the directors between them hold not less than what? 51% of its equity. So once you have that, that is the condition for you to call a company a small company. So whenever they meet this condition, that means that company is a small company and will be exempted from carrying out audit. So let's go to eligibility to act as an external auditor. That means what gives you the right or the power to act as an external auditor, which can be classified under two major parts. We have self-regulation by an audit profession, and we have regulation by government. Now, what do you mean by self-regulation and audit profession? That means there will be professional bodies which is responsible for their own self-regulation. They have their own code of conduct. That is related to what? To audit. Now, what do we have? We have ICAN. When it comes to audit in Nigeria, that means ICAN. That means ICAN members of ICAN can act as an external auditor, because ICAN gives them, once they are member and they have meet the what? The qualification to act as an external auditor as prescribed by what? By ICAN. That means they can act as what? As an auditor. It means that it is now ICAN that will now be regulating the activities of that member that is acting as an external auditor. So if that person fails to meet the technical competence, or the ethical, does not comply with the ethical standard of that professional body, which is ICAN, it means ICAN has the right to what? To remove the eligibility of that person to act as an external auditor. So let's go to regulation by government. Regulation by government. Regulation by government is an alternative to what? To self-regulation, where government appoints a public what? Body. Government appoints a public body to act as a what? That have a similar responsibility with that of a what? Self-regulation regulatory what? Body. That means, like government now, they will now appoint or delegate a power to a public body, maybe an MPA or a department or a ministry, to have the right to what? To determine who has the power or who is qualified to be an external auditor. Am I communicating now? That means is that public body that will not be regulating the activities of the people that will be the people that have been appointed as an auditor. Firstly, that means that public body will be in charge of who to be appointed to be an external auditor, and the ethical standard and the requirement to act as an auditor will be determined by that public bodies. That is what we call eligibility to act as an external auditor falls within two brackets. Am I communicating now? So we have earlier done right and duties of an auditor. So by next class we'll continue, because my battery is low now. We'll continue from international standard on audits. So what we are actually going to look at what constitute international accounting standard and how this standard is being developed. We are going to look at it. Those are the things we will look at in our next class.